2025 felt like the global economy and the stock markets were playing a high-stakes, multi-trillion-dollar game of financial chicken. On one side, the perma-bears were screaming from the rooftops about a looming recession, yield curve inversions, and the inevitable death of the consumer. On the other side, the bulls were buying AI stocks like they were the last remaining Pokémon packs on a dusty retail shelf. But look at where we actually landed as we moved through the last year. Unemployment remained stubbornly low. Consumers kept swiping their credit cards like the numbers weren't real. And anyone brave or foolish enough to short Nvidia aged an entire decade in a single fiscal year. It was a weird year, a confusing year, and a year that defied almost every traditional economic textbook. Now, as we step firmly into 2026, the air isn't getting any clearer. In fact, things are only getting more chaotic. We are standing at a massive crossroads. We're looking at potential rate cuts, the possibility of the AI bubble finally meeting its pin, and the endless debate over a soft landing, a hard landing, or the no landing scenario, which, let's be honest, is starting to look a lot like my dating life. Non-existent and confusing. 2026 is the year where the markets could finally blow the top off and enter a parabolic state of euphoria. Or it could be the year where you look back and realize you should have just parked your cash in 5% treasuries and shut the hell up. After getting flooded with messages asking what I think about the macro outlook, I realized that instead of answering you one by one, I should just lay it all out here. I know we're already a few months into 2026, but better late than never. I see three distinct paths: the bear case, the bull case, and the uncomfortable, choppy gray area that nobody is talking about. Because I am emotionally wired for disappointment, let's start with the elephant in the room, the bear case. Whether you believe AI is going to fundamentally reshape human civilization, or you think it's the most overhyped piece of tech since the Apple Vision Pro, one thing is mathematically undeniable. We have gotten way ahead of ourselves. The numbers simply do not lie. As of right now in 2026, Nvidia is still trading at roughly 47 times earnings. Palantir is hovering around 400 times earnings. And Datadog? Try over 430 times. At these levels, you aren't investing based on fundamentals anymore. You are effectively pre-ordering hope. The danger is that these AI darlings aren't just isolated bubbles. They are dragging the entire S&P 500 up with them. When Nvidia breathes, the semiconductor sector moves. When semiconductors move, the tech sector jumps. And because tech is the engine, the entire S&P 500 follows suit. We are currently looking at an S&P 500 trading at nearly 31 times earnings, double the long-term historical average of 16. If these multiples normalize even slightly, it won't just be a tech correction, it will be a systemic bloodbath. We haven't even touched on the circular spending problem, where 95% of companies are still seeing zero actual ROI from generative AI. We are building a massive skyscraper on a foundation made of hype and subsidized GPUs. This leads directly into the second pillar of the bear case. The market is dangerously top-heavy. The S&P 500 isn't a broad representation of the American economy anymore. It's a concentrated bet on a handful of companies. We used to call them the Magnificent Seven. Some call them Big Tech. I just call them 35% of the entire index. Think about that. Over a third of the value of the 500 largest companies is just 7 names. In 2025, these 7 stocks accounted for over 41% of the index's total returns. If you swap Tesla for Broadcom, that number jumps to 55%. This isn't diversification. It's a group project where 2 people do all the work, and the other 498 people get an A just for showing up. The explosion in passive investing is only pouring gasoline on this fire. Because most ETFs are market cap weighted, every dollar you put into an index fund gets disproportionately shoved into the very stocks that are already the most expensive. It's a beautiful feedback loop until the momentum stalls. If Nvidia drops 10%, it bleeds into the Nasdaq, then the S&P, and suddenly your diversified retirement account is catching a cold because one CEO in a leather jacket had a bad earnings call. Finally, for the bears, there is the simple law of averages. Since 1954, the S&P 500 has averaged a 10% pullback once every 3 years. We are statistically overdue. History tells us that after years of outsized, logic-defying returns, we eventually have to pump the brakes. Corrections are healthy, but when they happen from these heights, they feel like terminal falls. However, as the famous economist John Maynard Keynes once said, the market can remain irrational longer than you can remain solvent. Being right too early is the same thing as being wrong, which is why we have to look at the other side of the coin, the bull case. What if the markets just don't care about your PE ratios? What if the new era is actually real? The bulls are clinging to a massive fundamental tailwind, the Federal Reserve. Whether you think Jerome Powell is a genius or that he makes decisions by throwing darts at a board, the reality is that interest rates are finally coming down. 2025 ended with 3 consecutive rate cuts, and as we sit here in 2026, the market is pricing in even more. Lower rates mean cheaper capital, and cheaper capital justifies higher valuations. When liquidity loosens, risk-on assets come alive. This is how you get a market that continues to grind higher even when the news headlines feel like a dumpster fire. But the monetary side is only half the story. The real driver for the bulls is fiscal policy. While the Fed argues over basis points, the U.S. government is doing something far more impactful: spending money they don't have. We are now running on a $1 trillion deficit annually. While I've talked before about how this is a ticking time bomb for our grandchildren, in the short term, it is a massive stimulus package for corporate America. Government spending puts money directly into the system, propping up consumer demand and corporate revenues. Politicians don't win elections by telling people to spend less, so expect the spigot to stay open through 2026. Now, before we get to the most likely and most frustrating scenario, we need to talk about your personal environment. 2026 is going to be a year of intense research. You'll be staring at 10Ks, tracking charts, and watching the news more than ever. If you're going to be at your desk, you might as well be comfortable, which is where today's sponsor, FlexiSpot, comes in. Their E7 Pro standing desk is a game changer for anyone who treats their home office like a war room. It has a massive height range and can support up to 440 pounds, so it's stable even if you have 3 monitors and a heavy tower. It comes with a 15-year warranty, which is probably longer than most of the AI startups currently trading on the Nasdaq will last. Check the link below for a discount. Now, back to the markets. I've given you the bear case and the bull case, but here is the scenario that actually keeps me up at night. The one nobody is positioned for. It's not a melt-up, and it's not a crash. It's the gray area. Imagine a year of long, choppy, sideways price action. A year where a rally starts, everyone gets excited, and then it peters out for no reason. A year where a dip looks like the start of a crash, you sell your positions, and then it bounces back just enough to make you regret it. This sideways market is where wealth goes to die, not because of a crash, but because of impatience. It's a market where headlines flip-flop every 2 weeks, and every decision feels wrong. In this environment, capital just rotates. One week it's small caps, the next it's energy, then it's back to tech. It's a meat grinder for retail investors. The lesson for 2026 isn't to be a bull or a bear, it's to be a stoic. Understand that we are in uncharted territory. We have never seen this level of debt combined with this level of technological disruption and this level of market concentration. Anyone who tells you they know exactly how this ends is either lying or trying to sell you a masterclass. The best thing you can do is absorb the data. Stay diversified beyond just the top 7 stocks, and remember that time in the market usually beats timing the market, even in a year as weird as this one. So, where do you land? Is 2026 the year of the bubble pop, the year of the moon mission, or are we headed for the sideways grind? Let me know in the comments. I'll be watching.